Hello, everyone. Thank you for joining in on this webinar, and I hope that this is informative for each one of us. So today we'll be discussing about why we should invest in alternate assets and how Jiraaf can help in this space. We also have with us Mr. Siddharth Ladsariya. He is the founder of Everest Fleet, Uber's largest fleet operator in India. We'll be discussing with him in detail about a very exciting opportunity that is currently live on the Jiraaf platform. Before the end of the session, we have some time for Q&A. So do keep your questions coming. The chat window is disabled. So you can ask your questions in the Q&A tab, and we'll try and answer them towards the end of the session. Yeah, so I think let's begin. I'll start by introducing myself. My name is Saurav Ghosh. I am the founder of Jiraaf. My background is that I'm a computer science engineer from BITS Pilani Goa campus. I then did my MBA from IIM Ahmedabad. For the past decade, I've been working in the corporate finance space, where I've been largely raising capital, debt, equity, or structured products for the company that I worked for. In July 2021, that's about 6-7 months back, Vineet, my other co-founder, and we thought of Jiraaf and kind of started it up. We launched on 10th September, which was Ganesh Chaturthi. That's just 3-4 months back. So we are fairly new. We today are a 26-member team, and we are growing extremely fast. But before we get to more about Jiraaf and I tell you more about it, I'll just get to the topic itself, which is why should we look at alternate assets? So I'll just use the help of a slide for this. I hope my screen is visible. Yeah. So I think as Indians, actually investing our savings in traditional asset classes. So, and those are basically equity, which is either direct or through mutual funds, debt, again, either fixed deposits or through debt mutual funds, and then in real estate and gold. Right now, if you look at the journey of financial markets in India in 1990s, which is in that decade, the public markets kind of opened up, and we got access to invest in equities. The last 2 decades have been the decade for mutual funds and SIPs, and there's a large number of tech platforms or online platform that's making access to these products really convenient. So as Jiraaf, we strongly believe that the next decade or two will largely be for alternate products. Now, if you look at the table on the right, that's the current state of how we invest in as Indians today. The alternate investments just take a 1% of an investor's portfolio, in financial assets. And this 1% is largely contributed by HNIs and ultra HNIs who have basically access to these products. Over the last couple of years, we've seen a large number of online wealth platforms which have mushroomed. These are providing access to alternate investments and alternate products through the digital channel. And I've mentioned a few of them in the slide that you can see. So still the question is that how should we look at this alternate space? Now, if you look at the graph on the bottom left of the screen, on the x-axis, we kind of have risk, and on the y-axis, return. So if you look at the lower end of the spectrum of the risk return spectrum, you see the traditional asset classes of fixed deposits, bonds, gold, real estate. And at the other end of the spectrum, you essentially see the exotic alternate products today, which is crypto, art, angel investing, basically investing in startups. And then there's a large gap in between. That large gap largely has today public markets, which is your equities. So with Jiraaf, we strongly feel that there's a huge opportunity around these in this gap between the exotic products and your safe haven products like fixed deposits and gold and real estate, which is high yield fixed income products. And that's where we are catering to. So if you look at global studies and the global benchmark, most global studies will tell you that alternate products form 10 to 20% of someone's portfolio. Now, the question still remains that why should we look at these? I think the first and foremost reason is that alternate products are exciting because it helps you to diversify your current investment bucket. That you have been investing in traditional asset classes, alternate products kind of helps you to diversify. The key part over here is that it is very critical to ensure that a part of your portfolio is earning non-market linked returns. And earning non-market linked returns essentially helps you to balance out your portfolio. So that's critical as to why you should look at these products. The second is a more nuanced part of it is how fixed income products can actually play a big role in efficient financial planning. So I actually just mentioned two reasons reasons over here, but we can actually do a complete webinar on why fixed income products and how it can actually play a part in efficient financial planning. So the first example is, it can be a source of passive income. And let's take an example over here. So as Indians, again, we have a lot of dependents. So let's say that, I have dependent parents to whom I want to send some monthly cash, some monthly money for their expenses. Now, the most efficient way of doing this would be to, invest in an alternate product which gives you monthly cash flows, and you can just set aside the cash that you get from there, for your parents' expenditure. So that's a great way of, financial planning for expenses for your parents. The second example is, again, as Indians, we do a lot of milestone or financial goal-based investments. So one being, let's say you want to buy a car in 2 years' time, or you want to buy a house in 3 years' time, or you just want to save for your children's education or your son's or daughter's wedding. So in each of these cases, we largely tend to save our money in fixed deposits, right? Because you don't know across what horizon you're going to park your money, and and like products like equities and real estate, you're not sure of when the returns will actually come in and where you'll be able to liquidate your investments. So again, for these goal-based investments, fixed income products can be a great way to just make your financial planning more efficient. So because with these products, you exactly know, the returns are predictable, where you're going to get your cash flows, and for what time horizon that you're invested in. So again, these are just few of the examples that we mentioned, but these are the key reasons why this alternate space is so exciting and why we should look at them. The question still remains that as individual investors, we really don't have access to these products. And like I said, mostly it's been, participated by HNIs or ultra HNIs today. And I think that's where Jiraaf comes in. So just to introduce Jiraaf and, what we do over here as Jiraaf, I think at Jiraaf, we are solving three key problems. The first one being access. So, we at Jiraaf, we do the heavy lifting where we scout for opportunities. We do the credit and risk assessment and only list those opportunities which kind of pass our internal diligence. The second problem that we try to solve is that of ticket size, right? So like I said, most of these products are being participated only by HNIs and ultra HNIs. So we don't get opportunities to invest less than a few crores. So I think with what Jiraaf is trying to do is open these alternate products up for people even with a minimum investment size that's like 1 lakh, which is today. We are trying to bring that barrier down to probably 10,000 and 20,000 and make these products more mainstream. But that's a journey for us to, over the next decade, I would say. The third problem that we are trying to solve is for convenience. So, Jiraaf being 100% digital platform, you are able to, look at opportunities, view them, decide to invest, and then monitor them post-investment sitting at your home. So that's largely the problem that Jiraaf is trying to solve. The question is, and I saw a question in the Q&A as well. So one of the question is, what sets Jiraaf apart? I think the key thing over here is that Jiraaf is a multi-product platform. What that really means is that we are giving you alternate products across 6 or 7 asset classes within the alternate space itself, and that's where you get the freedom of choice. So with Jiraaf, you are able to basically invest in the alternate space, and you can manage your money on a single platform. And Jiraaf is basically a one-stop solution that also helps you choose products with tenors, which is basically between 30 days and 3 years, and get returns between 10% and 20%. So there's a big amount of choice, and choice is very critical to us because we are a consumer-focused platform. So the choice is with you on the kind of products that you want to choose, the kind of returns that you want to make, and the horizon of investment that you have. So if you want to just plan your finances better, you have a wide array of options at Jiraaf. And the next thing I think that sets us apart at Jiraaf is the team. Just quickly, show you what the team is like. I think we are a group of finance professionals with decades of experience in the corporate finance space who have come together to build Jiraaf. And I think that's where we kind of pride ourselves in the quality of opportunities that we bring and our own internal diligence and processes. And I think a clear example of that is, the Everest Uber Fleet transaction that we have right now on the platform. And that kind of brings me on to the next part of our, segment over here in the webinar. And I would like to welcome Mr. Siddharth Ladsariya. He's the founder of Everest Fleet, and I'm very happy to, have him on this webinar. Thank you, Siddharth. Thank you for taking out time, and a warm welcome to you.
Thank you, Saurav, for having me here today.
Yeah, thank you so much. So Siddharth, I think the first question, which all of us want to know over here is, you have a very exciting background, I would say. So you come from a family of entrepreneurs. You are a very active investor, in the Indian startup ecosystem. So the question is, if you could tell us, something a bit about yourself. And the second part is, why would you, find this fleet operations or this urban mobility space so exciting in India?
Sure. Thanks for the small introduction, Saurav. I'll just take it forward from there. Born and brought up in Mumbai, did my engineering, worked for a couple of years at ICICI Bank, then went to pursue my MBA to the US to Simon School of Business, and immediately returned back to India. My father is a first generation entrepreneur. Coincidentally, he's an alumni of your school, which is IIM Ahmedabad. And he's a first generation entrepreneur. He has his own business, and I came back to join my family business. As any family business, it was old styled and, not very exciting for a young kid to, on day one coming back. So he pushed me towards investing in startups, because that day startups had, was a kind of a very, very new concept back 12 years back. And that is how I started investing in startups. And then I figured out that this is really my passion and my calling, and made more than 150 investments in startups. Really enjoy it, really enjoy every minute of it, to live the dreams with these young entrepreneurs and see them change the world. So been very active with startups, and 5 years ago stumbled upon this opportunity where we saw that this asset utilization in this cab aggregator market is extremely low. So for example, a person who's driving a taxi, he typically drives his taxi for 8 to 10 hours a day, 6 days a week, and 10 months in a year. The remaining time, the taxi is unutilized. So the asset utilization is less than 40%. The thought came, can we take this to 80%? So run a double shift, 2 shifts, 365 days operations, the way they have in trucking, companies and shipping companies, So can we do a asset, very, very efficient asset utilization model? And with that, we bought our first 2 cars. We made a professional team along with a co-founder, and we bought our first 2 cars, and it worked. What we also decided at that point in time is that the market was dominated by diesel cars and sedans. We decided we will go only with CNG, which is clean energy cars. So we have not even bought one car till date which is non-CNG. We will only with that and hatchbacks, and that worked as well. So yeah, today, 5 years fast forward, we are at around 2,400 odd cars operating in 4 cities: Mumbai, Bangalore, Delhi, and Hyderabad. Have an exemplary team running this entire operations. We are very tech driven, and the largest partner to Uber in India, actively providing cars to Ola, piloting into various other businesses to portray ourselves into a full stack tech logistics player. And that's
No, I think that's super exciting. So how would you, I think the last 5 years has been great. You've now become Uber's largest fleet operator. Like you mentioned, 2,400 cars, running in the country. So what would you say is the next, phase of growth for Everest, and how do you see the next 3 years?
Yeah. So Everest, as so we have really cracked the art of managing drivers and recruiting, managing, and ensuring that the drivers are very, very efficient. So we have really cracked that. We have become a very, very big brand in the minds of drivers in the country. Just to give you an example, today we have around 1,100 drivers in our waiting list who want cars. We are not able to provide cars. What we believe is we have not, these drivers are not our employees. They are not, people who work for us, but they are micro entrepreneurs. So we are trying to foster entrepreneurship. So with this, we have taken an ambitious dream of our core business, Everest. In the next couple of years, we add 15,000 more cars, which automatically means around 25,000 more drivers being with us. And our dream is to create 100,000 jobs in India in the next 5 years. So we are all working as a company. We are all working towards that mission. Apart from this, we are also piloting into various other businesses in the logistics sector. So we are opening our own full stack garages across the country, the largest in the country currently. We have a feet on the street model to recruit drivers and recruit supply. We are starting a pilot of refrigerated vans for intracity transport. We are currently exploring various initiatives both on the bike and on the car side. So we want to become a full stack logistics provider going forward.
Great. That I'm very glad that you decided to, also partner with Uber, and we are able to play a role, in your growth journey. So that comes, takes me to the next question is, why did you choose this asset light model? And, the leasing transaction that we are essentially doing with Jiraaf is where, Jiraaf and the investors own the asset in a company and it gets leased out to Everest Fleet, right? So it essentially, you're not buying cars on your balance sheet, but partnering with a platform like Jiraaf, to kind of grow your car base. So why did you go for this model, and why does this make sense for you?
So initially we started off buying cars on our own balance sheet. The first, I think, 670 cars, we bought it on our own balance sheet using a combination of debt and equity. And then, COVID hit in, and then we realized the true realities of the world, that asset heavy models, very asset heavy companies, they can go through difficult times. So at that point in time, we decided that we will, keep our debt in control. We would rather give higher returns and a share of our profits to people, and make investors invest in assets, and not have a very, very heavy balance sheet. So this is the reason that we move towards an asset light model, as we call it. But a certain percentage we are still going to maintain on our books. We want to position ourselves as a fleet management company and not an assets heavy company. So, our expertise is recruiting drivers, managing drivers, ensuring that the service is flawless to the customer, ensuring the ops is flawless, the efficiency, that is our expertise. So we want to play on our strengths,
right,
and not on our, on some derived strengths, which is financing of cars. So that's the reason why we have moved.
No, makes sense. Makes a lot of sense. Yeah. So I think if, now from investors' perspective of evaluating this opportunity on Jiraaf, right? So why do you think this is a win-win scenario? Like, how would you look at it, let's say from an investor's perspective over here? So what we understood that in the model, it's obviously makes a lot of sense for, Everest Fleet to do this. Like you said, you minimize your risk and, grow and focus on your core operations. So now looking at the other side from the investor's perspective, how would you look at it?
So a few things. Firstly, investors get a chance to participate in a high yield return asset class, which is pretty significantly higher than what the other safer options are available in the market. The asset, the investment is backed by an asset which is liquid, which is cars. So if there's some problem or some default at any end, the cars belong to the investors. They can sell it or get them sold through us or Jiraaf, and the liquidity is insured to them.
Right.
So that is the second. Third is that they need to the investors get to work as a company. We are extremely conservative when it comes to our cash flows and when it comes to our financing. Just to give you an example, today we have around 8.5 crores of debt on our books, and we have around 25 crores of cash lying in our books.
Wow.
So we are, and this is a extreme conservative model that we've been following. We, as a conscious choice, we've decided not to take our net debt to equity ratio more than 1:1. So investors have a lot of safety with respect to all these factors put in together.
Got it. So if I just had to, play the devil's advocate and just ask, what are those key risks, that you would see, right? Like if as an investor, if I was asking you this question, should I participate in this opportunity? What are the key, say 1 or 2 risks that you would want to highlight and talk about?
See, the biggest risk that we perceive is, if taxi as a service, this age-old taxi model by some technological disruption, whether it's through these aggregator apps or it's taxi which you ride, hail, but taxi as a service goes away, it's a major technological disruption, then yes, then we are in soup. We are in a soup. Very, very minuscule chances of that happening. Second risk, not for which will not be for extinction, but a disruption that can happen is if aggregators like Ola and Uber were do not thrive. But our belief is that if Ola and Uber are not there, there'll be a third aggregator, or there'll be Everest, or there'll be, but taxi, as long as taxi as a service remains a concept, these cars will keep continuing on the road, earn rational fares, and the drivers will keep generating an income for themselves.
Right.
So these are the major risks that I see from an investor.
Got it. So I think we had opened up the session for Q&A as well. So I think Siddharth, the first questions come for you. The person, so Miss Tanvi Agarwal has asked this question. So how do you see business getting impacted in the current COVID situation? And given the Omicron wave, yeah.
Yeah, so just like to spend 30 seconds on our previous COVID experience. So
Yeah.
COVID hit Bombay India on March 23rd, 2 years ago. And on March 27th, we decided as a company that all our cars will come on the road and all our drivers will be ferrying the city of Mumbai. So at that point in time, we were the only company, apart from BST buses in Mumbai, we were the only company who actually served the city in various aspects, whether it was doctors, hospitals, patients, essential services, etc., etc.
Right.
The city paid us back very well. Earlier we did this more from a social responsibility. Later, the city paid us back very well. We have seen these waves twice. This is the third time for us. Yes,
right.
Business has been impacted severely currently. In the past 5 days, our demand, customers have reduced on the road. Demand has gone down. Nothing to be worried about. We have seen that we are extremely cash flows are extremely strong, and we will tide over it. We also see this current wave of Omicron and its impact on commercially on our business in the next 6 to 8 weeks. We expect this, and the overall COVID impact. Of course, nothing can be said about COVID if a fourth wave comes. But we expect the demand to return back to normalcy by mid of this year.
And how have you seen the demand just from the first wave of COVID till now? So, has demand gone back to pre-COVID levels, or where is the demand currently?
So demand has not gone back to pre-COVID levels, primarily because of the night shift. So night shift is airport, corporate and social. So that never went up to 100%. But the demand went up to 75%, which was very good for us and fairly profitable.
Healthy for
fairly healthy for us. Currently, the demand, 5 days back, the demand was in the 75% region. Today, the demand has fallen by, it's probably at 30%.
Got it. I think the next question is from Mr. Vijay Budhani. So I'll take that question. So his question is on the overall structure of the investment, the outflow, the inflow, the applicable tax, and the final return. So Mr. Vijay, I'll answer that question. So the way we are structured is we are creating a LLP, which is a limited liability partnership. So here, all the investors on the Jiraaf platform become partners in this LLP. So the capital that you invest is actually the corpus or the amount which is available in the LLP to purchase these cars. So this deal was for 100 cars, which is approximately about 4.8 crores. So, we'll raise 4.8 crores from individual investors, let's say like yourself. And once you have 4.8 crores, we buy these 100 cars. These 100 cars are then given on lease to Everest Fleet. And under a lease agreement that we have, executed, Everest Fleet is going to pay the LLP monthly returns. Now, monthly rentals. Now, those monthly rentals, if you draw cash flow, works out to 17.5% IRR, which is the gross yield. Now, because the money comes into the LLP, you essentially, what we do is we file returns for the LLP at a corporate level. We pay corporate tax at the LLP level. And then whatever money is left post-tax is distributed to the individual investors. So the post-tax return that you see, 12.4% IRR, is essentially the return that you get in your hands post the LLP or the company paying the tax. Since the company has already paid tax at a corporate level, the money that you get as an investor in your bank account is completely tax-free. So, so Mr. Vijay Budhani, I hope that answers the question. I don't see any other question. Oh, we've got one. So the question is, a typical car loan is 7%. And this is the higher interest rate to compensate investors for the credit risk. So that's the question. So either of us can take that, Siddharth.
I'll take
it. Yeah, sure.
So yes, definitely the higher interest rate is to compensate the investors for the risk that they are taking on us. We need to understand what are the risks that we are transferring to the investors. So the risk that we are transferring to investors is, suppose a force majeure event like COVID or something hits in, and we are unable to pay money for a month or 2 months, then we extend the duration of this contract, keeping the IRR the same. So this is one flexibility that we have taken and in this contract. Apart from that, we are giving our corporate guarantees, so the investors can invoke our company's assets and corporate guarantees in case the investment goes defaults. And so yes, so this is the only risk that we are transferring back to the investor. All the risk remains on us as a company.
Right. I think this question, sorry, was from Mr. Ravi Lath. The next question is, the PPT mentions that the EBITDA is around 4,000 per car. Estimated back of the envelope calculation indicate the operations are still not generating net profit or free cash flow. Is that the reason for higher return? No, so I don't. So the EBITDA is not 4,000 per car. So the net profit to, I think, Everest Fleet, and he can answer it better. So there is sufficient cash flows even at a 75% utilization level, which Siddharth was mentioning. So after paying the rental to the investors, to the Jiraaf investors, there is sufficient money left to Everest to run their monthly operations. So they have monthly expenses. So in fact, it is good to cover their monthly expenses plus leave some profit for Everest Fleet. So I think just on the exact numbers, Mr. Ravilath, if you want to get into that, we can always connect separately with the team post the call. The next question is Everest profitable, as most of the startups are loss making? So this is again
Can I answer that?
Yeah, please.
So Everest has been profitable, cash profitable, right from the day we have incepted. And there has been no month or no year where we made a cash loss. So you cannot consider this as a pure play startup, which is investing in only people and only technology and only marketing.
Right.
There was only 1 month, which was April of this year, when the second wave of COVID hit us as a surprise, where we made a 25 lakh rupees odd loss, cash loss. And this month is where we are expecting to make a cash loss. But apart from that, Everest has always been profitable.
Yeah, that's amazing, and very unheard of in the startup ecosystem today. So I think the next question is by Mr. Vivek. This question is, what is the fleet utilization rate in the current environment? I think you've answered that, but there's a question again, and a view on EVs being added into your fleet. So are you looking at electric vehicles?
Yes, sir. We are continuously looking at electric vehicles. So today, electric vehicles are not financially viable. So the cars that we buy for around 5,10,000 rupees, the similar cars are available at 9 lakh rupees in an EV. Of course, it's a sedan versus a hatchback, but on the aggregator platform, our revenues don't change much. So a 5 lakh rupee asset versus a 9 lakh rupee asset. Yes, EVs, the running cost is lower, around 1.5 rupees per kilometer. Our CNG cost is around 3.5 rupees per kilometer. Repair and maintenance again in EVs can be assessed to be lower, but all this taken together, it does not make sense for us as fleet operators today to enter EVs, because EVs also have a significant downtime. So you need at least a 6 to 8 hour window to charge the EVs on a sustainable basis. So yes, today for this use case of cab aggregators, EVs do not make sense. We are continuously keeping a watch, and the day it makes sense, we'll be the first people to enter the space. And that's why that's why you don't see any EVs in Ola.
Right. Yeah, that's right. I think there's a follow-up question by Vivek you also understand the broad unit metrics for a cab on a monthly basis. So at a top level, at how much Uber is earning, and then how do you make profit? I think this is a follow-up question to Mr. Ravilath's question earlier.
Should I give the broad numbers right now? I mean, in simplistic terms?
Yeah, I think that will help. Yeah.
It'll take me a couple of minutes.
Yeah, sure.
That will answer the previous question also.
Yeah.
Sir, let me first, so if suppose we get 100 rupees as revenue from Uber or Ola, 20 rupees is taken as commission from Uber, and 5 rupees is paid to the government as GST. We are remaining with 75 rupees. This 75 rupees forms our net revenue. Whatever revenue that I talk right now is going to be net revenue, the money which actually comes into our account. So today, on a last week or weeks before that, we were at a 70,000 rupee per month per car revenue on a fleet level all across India. 70,000
Right.
rupees, 69,000 something. 70 with simplicity, we can take it as 70,000. Our model is we straight away give 60% to the driver. 40% is for his salary or wages, and 20% is for fuel expenses. 40% is what is remaining with us. So 40% of 70,000 rupees is around 28,000 rupees. After this on this 28,000 rupees, we have to pay the investors or the bank EMI, which ranges anywhere between 12 to 14,500 rupees. So you can minus 14,000 rupees out of 28,000 rupees. Apart from this, our costs are insurance registration, technology cost, HO cost, and repair and maintenance cost. All these costs combined together is something like 10,000 rupees. Okay.
Right.
So after removing this 10,000 rupees and 14,000 rupees, we are still left with a 4 to 5,000 rupees free cash flow on our operation level. Apart from this, we also get money in various forms, which is ancillary income or money, for putting up an upfront money for putting cars. So with all this maths, we are healthily profitable.
Right. Yeah, that's very helpful, Siddharth. The next question, I'll take that. Is there any impact of GST on the transaction? Mihir Patki has asked this. So Mihir, we have made the entire structure very GST efficient. So what we do is that at the time of buying a car, there is a huge GST outgo that the company has. And at the time of, when we get the monthly rentals, which has a GST impact again, we get a set off against the GST that we paid while purchasing the cars. So overall, over a 3-year period, this is, GST very efficient. So there is no net loss to the individual investors from a GST perspective. Right. So I hope that answers the question. I think the next question is, how are returns calculated in these deals? It's been asked by Ms. Sonal. So Sonal, I think what effectively we do is that, there is, you are investing, let's say 1 lakh upfront, right? So every car costs 5 lakhs. Let's say as an individual investor, you decide to invest 1 lakh upfront. So you will get a monthly rental to directly your bank account, which is post-tax, right? And at the end, you get one lump sum payment. That is when Everest actually buys the car back from the LLP. Now, if you look at the overall cash flows, which is there is a monthly rental for 35 months. And at the end of the 36th month, because this is a 3-year deal, you get a rental plus a lump sum amount at the time of the buyback. So if you just, on an Excel, if you just work out what these cash flows, give you, it will work out to a 12.4% return. So that's how we're calculating the returns in this case. So I hope that answers the question. The next question is, does it make any difference in taxes if I'm investing as an individual or as a HUF? The question is by Ankur Maheshwari. So Ankur, it will not make any difference. So I in fact recommend that you people in even a high tax bracket should invest from their individual names, because the money that you get into your account is effectively post-tax. So the return that we give to the individual is under a share of profits or return of capital, which is not taxable as at the hands of the investor. So it really doesn't matter if you're investing as an individual or HUF. So I would recommend if you're even in a high tax bracket, to go for your individual. The next question is, and we'll just take one more question after this, since we're running out of time. The next question is from PV Hari Krishnan. So this question is, what is the recourse to the investor if there's a default in payment of lease rentals? So I'll take this question, Siddharth. So I think we've structured this transaction to ensure there is recourse at 2 or 3 levels, right? So one is that if there is a recourse because Everest Fleet has contractually agreed under the lease agreement to make these payments. One is we can obviously enforce that lease agreement and ask Everest Fleet to pay. Now that is a legal recourse that we have. Step 2, step 3 is, step 2 I would say is, like Siddharth mentioned, there are multiple fleet operators in the country. Everest is definitely the largest one today, but there are multiple fleet operators in the country. The biggest security in this structure is that the car belongs to the LLP, which is where the investors are partners, right? So the asset ownership is always with us. Now, when I say with us, with the company, which is where the investors are, limited partners. So because the asset ownership is with us, even if Everest Fleet kind of shuts operations, we can always lease out the same cars to, let's say, the second largest fleet operator in India of Uber, or probably a fleet operator of Ola, and a similar structure can continue. So one is, if Everest shuts down, you always have other fleet operators to go to. You can then work out on a similar lease model. Third is, because again the cars are owned by the LLP, we can sell these cars in the secondary market and realize the residual value. Now there's a huge market for secondary cars. All of these cars which run as cab in the metros and the in the metro cities, they have a very large and active market in tier 2, tier 3 cities. So you can also sell these cars in these secondary markets and realize the residual value. So so the to answer your question, Hari Krishnan, so there are three levels of deal. One is you have a legal recourse with Everest. Second is you give it to another fleet operator. Third is you can sell your car and recover your money. So I hope that answers the question. Great. I think no more questions, and that's the end of the session. So Siddharth, thank you so much. It was very informative. I think for all of us over here to understand the transaction better. Thank you for taking your time.
Thank you, Saurav. Thank you.
And thank you to everyone who participated in this webinar. I promise that we will have more such webinars in the future, and try and educate the crowd out there of the alternate product space. And I hope you guys log into Jiraaf. Do visit the website. We have a lot more information there. If there's anything that you want to understand more about Jiraaf, this particular transaction, you can always reach out to our support team, and we'll be happy to help you. So thank you so much, guys, and hope you had a good time. Thank you. Thanks for that.